In today's video, we'll look at my dividend growth portfolio on M1 Finance and see how it's performed so far. We'll discuss why I sold one of my holdings and explore why another company I own is currently down 76% and what I plan to do with it. I'd also love to get your opinion between two companies I'm looking to add to the portfolio this month. Finally, we'll take a quick look at the technicals on the broader market. Hey guys, I'm Tex. If you're new here, I share my journey and experiences with trading and investing in the stock market. Thanks so much for watching. Let's go ahead and get started. Okay, so looking at the portfolio here, first thing we might notice is that they launched a new design for the website and the mobile app. It definitely looks different, but I do like it. It's clean, laid out really well. We see the account is sitting at $17,046.79, and we do have an increased net cash flow of $21,173.16, partially because we did receive some dividends, but also because I made a regular contribution to the account, which automatically got invested. Our paper losses is down at $4,088.19, and our money weighted return is negative 26.09%. We do have $38.18 in earned dividends, but I should clarify that earned dividends isn't necessarily dividends that we have physically received yet. So you actually earn a dividend, but there's usually a little bit of a waiting period until the money actually gets to you. So if we go to our activity page and we sort by dividends only, here is the dividends that I've actually received. We have $1.08 there for Nike, $4.68 for Coca-Cola, another $4.68 for LTC Properties, $6.14 for Home Depot, and so on. So this is actual money that I received in dividends, and that money gets reinvested into the stocks in my portfolio. If we go and sort by trading, we can see that on April 3rd, there were 8 purchases made, a big one here into Store Capital, and we're going to really look at the real estate sector here in just a moment. We bought more in Apple, the Trade Desk, and so on. So it's definitely nice to see these dividends getting reinvested. For example, here on April 2nd, $10.53 was purely from dividends received. So M1 Finance automatically went and invested that money into the portion of the portfolio that needed it the most. So that $10.53 was invested in Delta Airlines. So looking at the overall portfolio, of course, we are still down considerably. On a positive note, we're not down quite as bad as the S&P 500. Of course, we have been cost averaging in this entire time. If we go and look at just the week, we're down 6.18%. Initially, we did get a nice little reprieve on the portfolio as the market bounced up. The question is was it a dead cat bounce or not? We don't know yet. We'll look at the technicals in a minute. There is still a chance the market could go substantially lower. Is that going to change my investing strategy? No, it's not. I'm still going to contribute and invest in this account every time that I have any extra money to do so. And that's not going to change regardless if the market, continues falling or we do end up recovering. I will just continue to invest. Again, this is for the long run, so I'm not really concerned about what's going on in the market as far as these volatile swings one way or the other in the very short term, this week, next month, next year. Now I just want to look at this website called Simply Safe Dividends. I'm giving the free trial a go. I don't yet know if I'm going to subscribe to the service, but I have to say I'm very impressed with the research available on the website. Really, one of their key features is their dividend safety score. So basically, they score companies in terms of how safe their dividend is. A company that is very safe or safe is considered very unlikely to cut their dividends, where unsafe or borderline would be companies that are at risk of their dividends getting cut. So that can really help you as far as your research goes into particular companies that you might want to invest in, because obviously as dividend investors, it's very important that we're investing in companies that don't have a high chance of their dividend getting cut. But what's nice is I can put all of my holdings into the portfolio here, and we can see a snapshot. We can see what my actual annual income is, currently sitting at $698. Now, my portfolio did take a hit on the annual income because of one of the companies that I was invested in slashed their dividend, that is NRZ, and we're going to talk about that in just a minute. So the overall annual income on the portfolio took a big hit when they did slash their dividend, but there's still a big chance that more of these companies could end up suspending their dividends or certainly cutting their dividends. Among other things, we can see the dividend yield on the portfolio is at 4.09%. We can see just a snapshot of our diversification, and more importantly, we can see a snapshot of our dividend safety score among all of our holdings. So the majority of our holdings is considered safe, so that's definitely a good thing. However, 25% of our holdings is considered borderline safe and 2% is unsafe. Overall, I'm very impressed with the website. They do have a lot of research on each of these companies, which can be very helpful for you to understand the company better, how they make their money, and how well they're positioned in order to continue paying their dividends. Going back to our portfolio, what I want to discuss now is our real estate sector. So as I said, I'm invested in individual companies. I've broken those down into their respective sectors. Now, real estate has taken a beating since this whole thing has started. If we go into our real estate sector, I have 4 holdings: Realty Income Corporation, LTC Properties, Store Capital, and NRZ, which is New Residential. Now, the top 3 here, these are actual real estate REITs. These are companies that own physical real estate, and they make their money essentially by renting out their properties. New Residential is what's called a mortgage REIT, and I'm absolutely getting obliterated on this. I'm down 86.79% money weighted return there, or $857 in the red. Now, I paid a really high dividend yield, as do most of mortgage REITs. However, they're highly speculative investments. They don't tend to have the kind of consistency as far as paying dividends over a long period of time. They'll pay really high dividends, but if things turn sour, they're very quick to slash or totally cut their dividends. So unlike Realty Income, LTC Properties, and Store Capital that actually own physical real estate, a mortgage REIT is it's different. They essentially obtain financing from debt and equity markets in order to raise capital to buy longer duration and higher yielding real estate related securities. The difference between these short and long-term yields is called the spread, and combined with higher amounts of leverage allows a mortgage REIT to generate high enough net yields to pay investors generous dividends, for which the industry is known. So why is NRZ collapsing so badly right now? Well, first of all, recession fears is making the value of mortgage-backed securities owned by NRZ decline in value because credit risk rises in a weak economy. Second, NRZ has been forced to sell some mortgages at a loss due to liquidity concerns. The more this gets dragged out, the more this goes on, the more at risk this company would be at going bankrupt, essentially. And third, mortgage REITs have been excluded from this massive government stimulus. So NRZ is not going to be among the companies that would be able to receive government assistance. So there's certainly a risk that NRZ could go bankrupt. I think that they'll probably be able to come out on the other side okay, but if this drags on for too long, they are definitely at risk of going bankrupt. So what do I plan to do with the company? Well, as of right now, because I am down so dramatically on the company, I'm definitely not going to sell it for a loss, because if things do bounce back, NRZ has a good chance that it will definitely bounce back and they could get back to paying a really high dividend. They didn't totally cut their dividend, but they slashed it almost completely. So the amount of money I'm making on the NRZ in terms of dividend is really not worth the risk in terms of if you were to invest in it right now. But I also don't think that it's worth selling it for a total loss at this point in time. So what I'm going to do is just not put any new money into the company for the time being. And then once we come out on the other side of this, if NRZ is still positioned well in terms of not going bankrupt and has a good chance of bouncing back to paying really high dividends again, then I might go ahead and start putting more money back into the company. So as of right now, we're just going to keep the allocation down to the point where no new money gets invested in NRZ, and all new money invested in real estate will be split up between Realty Income Corporation, LTC Properties, and Store Capital. So going back to the overall portfolio, I want to discuss the holding that I decided to sell, and that is Boeing. Inside of our industrial sector, I had Boeing along with Delta Airlines and Caterpillar. So Boeing, I was cost averaging in over time as it was kind of selling off in the past month. So I was able to get a decent cost average in as I was buying, as it was coming down. It really got extended to the downside and then started to bounce. So as Boeing was bouncing up, it got very close to my cost average and I decided to go ahead and just sell it. I took a small loss on it, but I was able to recoup the majority of the money I had invested in the company. Now, the reason I sold it was really because the fundamentals have deteriorated so badly on Boeing. I expected that they would cut their dividend, and they did. The problem is that the fundamentals on the company are so bad that the bailout they're going to get from the government and the stipulations of that bailout means that it'll be years before Boeing will ever be able to pay a dividend again. Essentially, Boeing's going to have to pay back the entire loan that they are getting from the government, and then beyond that, they have to wait another year before they could ever pay dividends again. So I kind of felt like that money would be better put to work among other companies in my portfolio rather than just leaving it in Boeing and not really doing anything for me for the next few years. So as of right now, inside of my industrial sector, I only have Delta Airlines and Caterpillar. Now, it's also worth noting that Delta Airlines is another company that has suspended their dividend. And like Boeing, they probably will not be able to pay a dividend again until they pay back the loan that they get from the government, plus another year on top of that. However, the fundamentals for Delta are far, far better than Boeing. So I think in the long run, Delta will be able to get back to the point where they'll be able to pay dividends again. But as of right now, I'm not getting any dividends from Delta. So inside of my industrial sector, I'm only getting dividends from Caterpillar. Now, as a result, I would like to add another company inside of this sector that does pay dividends and doesn't really have a particularly high risk of cutting their dividends. So this is where I'd love to get your feedback. There are two companies that I'm looking at, and we'll discuss their business models, and just let me know in the comments below which one you like better. I can't promise that I'll pick the one that you guys like the best, but I'm definitely curious to hear what your thoughts are. So the first company I want to talk about is Cummins, and they are the largest dedicated global industrial diesel and natural gas engine manufacturer. Their products are sold in more than 190 countries. About 60% of their revenue is generated in North America, but China at 10% and India at 4% are also meaningful markets. As far as dividends go, they have paid uninterrupted dividends since 1993 and increased it every year since 2006. So that's a very positive thing for a dividend growth portfolio. When we break down Cummins revenue, we can see that 35% of their revenue, 41% of operating profit is essentially from their engines, so from building diesel and natural gas engines. Distribution makes up 26% in sales, 16% in operating profit. Components, 24% of sales, 39% operating profit. Power systems, 15% of sales and 17% of operating profit, and electrified power, basically very little at this point, less than 0.1% of sales. Like any investment, there's always risk. When we look at the specific risk for Cummins, one of those is the threat of a strong dollar. Another thing to consider is the cyclical nature of the truck market, which can also cause short-term challenges for the company. During the 2008 financial crisis, Cummins sales declined 25% and its earnings fell 40%. So if we are in fact heading into a pronounced recession, then there's definitely some risk to this investment because we could definitely see their sales again decline the same as they did in the last recession. So overall, cyclical end markets, currency volatility, and trade tensions ultimately seem unlikely to threaten Cummins' long-term earning power, but increasing competition could. So the question would be, is Cummins positioned to compete with the rising competition over the coming years? So the second company that I was considering is Honeywell International, and this is a diversified industrial giant operating in about 70 countries. We can break down their revenue among three primary areas, the biggest in aerospace, where 38% of their revenue comes and 41% of profits. The second is home building technologies, which constitutes 23% of their revenue and 21% of profits. The third is performance materials and technologies, 24% of revenue and 27% of profits. And the last is safety and productivity solutions at 14% revenue and 11% profits. This article was interesting, discussing Honeywell, which we basically just discussed. They are an industrial giant with the majority of their revenue derived through the aerospace and defense segment. They do say, although earnings for its aerospace division will certainly deteriorate amid the pandemic, it's important to understand that Honeywell isn't as vulnerable to the collapse of commercial air travel as aircraft manufacturers or airlines. Yet a slowing economy and oil below $30 will certainly take a toll on Honeywell's construction business and Honeywell UOP, which mainly supports the downstream sector of the oil and gas industry. But they do emphasize that Honeywell's business will take a hit, but only certain parts of its diverse stream of revenue will be severely impacted. So that's a definite plus because they are such a big industrial giant and they're so well diversified that although they'll take a hit in the long run, most likely they'll be one of the companies to come out of the other side just fine. In terms of their balance sheet, they've done a good job of keeping it in check, all while increasing dividend payments every year for the past 20 years, thanks to strong cash flow. Theoretically, free cash flow could fall by 50% or more, and Honeywell would still be able to pay its dividend with cash. Of course, the worse things get, any company could eventually reach the point where they wouldn't have enough free cash flow to continue paying dividends. And so that's why we do see the risk that some of these companies could yet still cut or suspend their dividends. However, they do mention that income investors can rest assured knowing that Honeywell's dividend is just about as solid as it gets for an industrial. So we'll just quickly look at the two companies on Simply Wall Street here and just get a sense of their valuation, their future growth, their financial health, and basically get a sense of which one might be the better investment. So starting out with Cummins, if we look at the valuation, it is currently 27.5% undervalued. They're saying fair value is at $182.47 a share. So there is definitely some value there to be had, at least at this point in time. If we look at their future growth, this is not quite as rosy. Future growth is down 4.4% there. And that's partly because of the downturn in the economy right now. If it's short-lived, this future growth could improve, but if it's going to be a long drawn-out recession, the same as we discussed in the risk with Cummins that we saw in the 2008 recession, sales and revenue declined dramatically. If we look at their financial health, this is where I think Cummins really excels. Between the two companies, their short-term assets exceed their short-term liabilities, and their short-term assets exceed their long-term liabilities. Looking at their debt-to-equity history, very nice graph to see here. And most importantly, their debt-to-equity ratio is only 26.9%, which is actually really good. So overall, their balance sheet looks great. And they definitely seem like a company that they would be able to come out of the other side just fine. But if we have a long drawn out recession, we have slowing sales, it's going to impact the company in the short term. The question is, in the long term, will they be able to continue growing, beat out the competition, and continue to pay dividends well into the future? Moving on to Honeywell, if we look at their valuation here on Simply Wall Street, it is also currently undervalued at 25.9%. Looking at future growth, it's not negative, so that's a positive compared to Cummins, but it is only 3.2%. So we're not looking at really stellar future growth, but there is some growth to be had there. Moving on to their financial health, Honeywell is not positioned too poorly. Their short-term assets exceed their short-term liabilities, and their short-term assets exceed their long-term liabilities. Looking at their debt to equity history, it's not too bad. It's not as good as Cummins, but it's acceptable. The only note that I would mention is that their debt to equity ratio is getting a little bit high at 84.4%, but it's not terrible. So between the two companies, both of them seem like pretty good investments. They both have very safe dividend scores on Simply Safe Dividends, so there's not as much of a risk of their dividends getting cut compared to other companies. They both have pretty healthy balance sheets. I would say Cummins a little bit better than Honeywell. However, Honeywell is a much more diversified company. So I think in terms of extreme long-term, Honeywell might be the better pick versus Cummins, especially if in the future we move more and more towards battery operated cars and less from gas and diesel engines. But at this point in time, that's not going to happen overnight, and we could definitely see profitable years investing in a company like Cummins. So it's a tough pick. I'm curious to hear what you guys think. Let me know in the comments below, which company do you like better, Cummins or Honeywell? So let's wrap up with just some quick technical analysis on the broader market. We're looking at the S&P 500 futures here. I still have my fib drawn from all-time high to the low of the sell-off, and we can see that on this, what could possibly be a dead cat bounce up, we've definitely found resistance right into the 38.2. We have not been able to break over that. Additionally, we have that 20-period moving average providing resistance for us that we're currently butting against right there. So I think if this really was the bottom here, we still need to come down and test that bottom. That bottom needs to be tested, either a true test or a higher low or something. It needs to come lower and prove that that was the bottom. I'm more inclined to think that it's not. I do think that we're going to come lower, especially since we still have a lot more negative news to come out. But one thing to keep in mind, the market is a forward pricing mechanism. So the market will bounce before the news turns positive. But overall, part of the bottoming process would typically be a test of lows. If we don't come down and test that low and we continue to rally up higher, then I think that we could definitely be seeing a retrace up into that 50% level right there. And I'd be really curious to see what happens at that point. I think that the likely scenario is that we would pull off of that and then come down and test the bottom. So we'll see what happens in this coming week. The next couple of weeks are going to be pretty bad for the US here. So that stream of constant bad news will definitely be a drag on the market. But just keep in mind, it is a forward pricing mechanism, so it's going to bottom before the bad news stops. Now, it is interesting that we have some divergence right here on our RSI. So basically, as price was coming down, the RSI was putting in higher lows. So the market was putting in lower lows while the RSI was putting in higher lows. So this divergence can continue for quite a while. It doesn't necessarily mean that the market has bottomed. If the market does come back down to test that low, would be interested to see what it does here through this divergence on the RSI, but it was interesting nevertheless, so I thought I would point that out. Now, if we are going to come lower, I want to go to our monthly chart. I've added an extension level here underneath of the low that we put in. So I like how that lines up really nicely with the bottom side of this range right here from 2015 and 2016. We can see the low that we put in almost tested the top of that range, but not quite right there. So if we do break this low here and the market continues lower, I like this 1841 area because that would bring us again right across that support area from the bottom of that range throughout 2015 and 2016. And that would also be that first extension level from our fib drawn from all-time high down to the low of the current sell-off right there. Now, if we break that and the market really falls apart, again, I still stand by probably going to be coming across here. This is the highs before our 2008 recession. Here's your 2008 recession right there. So you extend that across and that brings us roughly into 1600 there on the S&P 500. So you've also got this 200 SMA coming up right there on the monthly chart. So there's there's some areas below that we could certainly be testing. If we break that low so far that we've put in, I definitely like this right here as our first target. That's what I'd be looking at, and that's roughly around 1800 there on the S&P 500. Switching over to the NASDAQ futures, this is our monthly chart. So far, we're holding just above that 50 SMA on the monthly chart. Again, I drew a Fibonacci retracement on a potential downside if the NASDAQ futures does break this low, the same as the S&P futures. Our extension would bring us right across here, and I really, really love that because this is the low from that December correction, December 2018 correction. And that first Fibonacci extension is coming perfectly aligned with that. So I love that. Going over to our daily charts, basically the same situation. We have our Fibonacci again drawn from all-time high to the low of the sell-off, and the same thing as the S&P futures. So far, the NASDAQ is really having a lot of trouble with our first retracement there at 38.2. So I think that staying below that definitely increases the odds that we're going to come down and test this low. Whether we break or not remains to be seen. We'll just have to wait and see what happens, but very similar situation as the S&P 500, except the levels are obviously a little bit different, but we do have some nice Fibonacci levels lining up with key technical support as we just saw. So overall, I think there is still a chance that we could yet come substantially lower in the market. It remains to be seen just yet, but my overall investing strategy is going to remain unchanged, as I said. So that's going to wrap it up today, guys. If you have any questions or comments, feel free to leave those below and I'll make sure I get to each and every one of you. I hope you guys are doing really well and staying safe, and if you work in any essential business, especially if you're a nurse, a doctor, grocery stores, or whatever the case may be, I just want to say thank you very much for your service. We would not be able to survive without you guys. You guys are really the heroes on the front line. So I just want to say thank you to all of you guys. Again, I really appreciate you watching. Take care, and we will catch you in the next one. See ya.